Thanks to our friends at The Motley Fool for sponsoring this video. Check out the link below, fool.com/the smattering, to get access to the 10 best stocks to buy right now. There is an absolutely massive amount of investor interest in dividend stocks right now, and I get it. The market's still down. It's been super volatile. Interest rates are up. Investors are looking for safe investments that they can count on. But it could be a huge mistake right now to load your portfolio up on dividend stocks just to try to build a safe portfolio. We might have a better alternative for you. This is The Smattering. I'm Jason Hall. I got Tyler Crow here with me. We're going to talk about this for a couple minutes. Hey, Tyler.
Kind of a topic we've been dancing around for a while, but the more and more we think about it, it's like, yeah, this needs to be said.
Well, and I think there's an important part of it too, because you and I have had kind of a penchant for looking for dividend stocks and dividend growth stocks for some time now. We both have owned our share of those back before it was cool, right?
We're the indie band at Dividend.
Well,
we knew them when they were cool, weren't they? When they were cool, man.
It's kind of funny, but that's kind of the case. But I get it. People are looking for yield because if you buy a good company with a good dividend, you're going to get it every year. The best companies that grow that payout, right? So you're going to get more. But to me, it feels like, and this is the mistake part of this conversation, it feels like a lot of investors are rushing to move to those safer dividend stocks right now. And for some of those companies, it's pushed the yield down because investors are bidding up the price for a lot of those stocks, right?
Yeah. I mean, you're seeing across the board with, we'll call it the dividend flight to safety, right? You look at these.
Let's call them stalwarts because a lot of them are stalwarts. Yeah.
They some of them take a title that makes them part of British lineage, but that we can't mention. But just the idea that these are safe stocks, right? Like you can get yields a little bit better than the S&P 500, but something's changed over the past year that really changes the dynamic of how you invest your money, and that's how much money your money makes right now, just sitting as cash. If you have a brokerage account, and I have to speak specifically to
you need to validate it with your brokerage. And I think the key to me is that if what we're about to talk about, if you can't get it through your brokerage, it may be time to shop for a new brokerage.
Yeah. It's called money market funds. You've added cash to your brokerage. That money sits in what's typically called a money market fund.
That's a cash equivalent investment.
Yeah, it's a short term. It's basically your brokerage puts you in a short term marketable security, and it just sits there, right? Now, last year, that short-term marketable security that your cash just sat in on your brokerage didn't make any money, right? Maybe an annualized yield of 0.01% or 0.5 or whatever. That's not the case anymore. The yield on most money market funds that your brokerage has you in right now. I checked mine this week, and for Fidelity, my money market funds are 4.2%. Now, perhaps we're interest rate speculating a little bit, right? And money market rates could go down. That's entirely possible. It happens. But let's just play out the idea that they stick around at this level for a long time. If I can just let my cash sit there and get 4.2%, this is in U.S. government treasuries, very liquid marketable securities, lower risk profile than buying into individual stocks or even ETFs or anything like that. So if that's the minimum hurdle that I can get over just by letting it sit in, free parking, why would I want to jump into a dividend yield that is currently at 3% and grow 3 or 4% annually? That just doesn't seem to make as much sense as just sitting in a money market fund right now.
I want to be abundantly clear here. This isn't Tyler and Jason making a call to move to cash by any stretch of the imagination. The key is I think we want to caution investors from making the mistake of rushing into dividend stocks to try to move into something that's safer and potentially overpaying and hurting their returns over the long term simply because they're focused on that dividend and that dividend yield, when these higher yields that you can get in money market right now give you ample opportunity to keep more cash in your portfolio, earn some yield at pretty attractive rates while you take your time to evaluate the investments that are going to be the best to reach your long-term goals.
You're being compensated right now to be choosy, to be more selective. And that's the point that I want to get at. You don't have to be running out to buy things to protect your purchasing power.